Well, it has been a brutal housing market for home buyers between a lack of inventory, high prices, and high mortgage rates. But that doesn't seem to be affecting some of the home builder stocks. Joining us now is John Lovallo, UBS Homebuilders and Building Products Analyst, to talk about the outlook for this space. So, John, wanted to start sort of big picture here, right? Because the home builders have been in an interesting position because of the tightness of the market. There seems to be a lot of demand for new inventory. So have we seen sort of a rising tide for all of the home builders as of late?
Yeah, Julie, thanks for having me, first of all. I think that's exactly right. The environment out there today is such that there is very little existing home supply. Think about it, mortgage rates went from 3.25% up to almost 8% a month ago. They've trailed back about 90 basis points since then, but are still at very high levels. And when you put that in the context of something like 80% of mortgages in the US being struck at 5% or below, and almost 60% at 4% or below, that's created this lock-in effect where people don't want to move. They can't make that math work. And surprisingly, overall demand has remained resilient. So the extent that someone wants to buy a home today, more than at any point in history, they've been forced to look at new homes. And I think when you couple that with the fact that the new home builders on the public side have the ability to offer a lot of attractive financing options, that has created a lot of market share wins for the public home builders. And to your point, has created this sort of rising tide lifts all boats for the publics.
And John, I'm interested too, when you look at your coverage universe, these home builders, John, have their business models kind of shifted at all in the last few years? For example, have they become more efficient?
100%, Josh. Look, I think that this is something that is not fully understood or appreciated yet in the valuations of these stocks. Is if you went back a decade ago, in many cases, and not to be disparaging, but in many cases, these companies were looked at as land speculators that at the end of the day will put a home on to monetize that land. That has changed dramatically. They are truly focused on the home and on the community development. They have delevered. They carry less land. They carry better land. And in fact, they're doing much more, I would say, diversified things with their capital, where they're not putting every dollar of cash flow back into land. They're paying dividends, they're buying back stock. So they are much different companies, in our view, require probably a higher multiple. And to your point on the way they're building, they have absolutely become more efficient as a function of COVID. They were forced to. They're offering less SKUs. They're building homes a lot more efficiently than they have in the past, and that's evident in the returns.
Can they sustain this level of returns going into 2024?
A great question, and it's one that is highly debated at this point. I'll be honest with you, we are a little bit more cautious than I would say some of our sell-side competitors, and we believe that the higher interest rate environment, and who knows where rates go, but let's just say they're higher for longer, is going to cause continued sort of incentivization, which will weigh on margins next year. Now, to be perfectly clear, we expect margins to remain above historical levels, but maybe trend down off of today's sort of mid-teens. If that is the case, you will see some normalization in returns. But let's be clear that even on our estimates that are, call it 15% below our sell-side competitors, the stocks still look very compelling from a valuation standpoint.